Welcome back to the Dividend Diplomats YouTube channel. Got Laney and Bert, the Dividend Diplomats. We are hyped up. We are amped up. We are ready to go. Why, Laney? Because a Dividend Aristocrat dropped nearly 10% after they released earnings this week.
Will you listen up, brother? The big brand themselves, the Dividend Aristocrat, the 44 years of consecutively increasing their dividend jack, had just had a 10% decline in the stock price. So what you gonna do, Bert, when the Dividend Diplomats dividend analysis for you?
We're gonna smash that subscribe button. We're gonna give us a thumbs up. I'm gonna do my best Mean Gene here. Hulk Hogan, what are you gonna do here as you are talking to Macho Man about this company?
What am I gonna do, Mean Gene? Well, I'm gonna take these 24-inch pythons. I'm gonna look at the dividend stock analysis metrics, brother. And if they match up, and if all the suns in the universe is aligned, we are going to lift them up. And the whole world and the dividend maniacs are going to see, brother. They're going to see that you need to take your vitamins, you need to save your money, and then you need to consistently invest.
That sounds like a plan to me. Wait, what is that? Oh, yeah. We're going to run this company through the stock screener. You're going to save your money. We're going to talk about the three metrics of our screener, Hogan. You can take your 24-inch pythons that nobody cares about, and we're going to elbow drop this company's analysis on all of you diplomaniacs.
Well, it's time to get in, everybody. This Dividend Aristocrat just had a stock price drop, bad earnings release here on August 3rd, 2021. And if you're ready to listen to this, definitely ring that bell. Give us a thumbs up right now on the video. We're about to be at 10,000 subscribers. And this video is going to have to go out to the millions and millions of dividend investors out there, because that's what we do, baby. So, Bert, what stock had bad earnings release? What happened to the stock price? And let's dive into what happened in the earnings.
Well, I got a nice little lemon scent going around my house here because this company owns one of the regular household cleaners that the smell everybody recognizes. We are going to talk to you about Clorox, ticker symbol CLX. They are the king of the crop of consumer staple stocks here. Every dividend investor wants to get Clorox in their portfolio, but truth be told, been hard to find Clorox trading at a discount over the years. They are trading at a premium for a reason. That is why we are so amped up. And after we saw earnings and we saw the stock drop nearly 10% in one day after the earnings, we had to jump on and talk to you about this. We'll peel back the earnings release, look at some of the brands, and then run them through to see, even after a 10% drop, is Clorox going to be an undervalued dividend stock to buy?
And we're going to find out that this dividend stock is too sweet. So with Clorox, Bert, they dropped 9.46% today. They quite literally dropped $17 in share price. In fact, this year to date, Clorox's stock price is down over 18%. And in the last year, Clorox is getting its legs taken out from under them because they're down a whopping 31% since last August.
That's insane, though. If you stretch the history out a little bit, though, you have to take the perspective that Clorox was one of the companies that benefited heavily right at the onset of the pandemic. You couldn't find a Clorox wipe anywhere, and it caused the stock price to jump up along with a lot of the other cleaning supply companies. But yeah, when you stretch that out, come August, when they reach those highs, the company is definitely down from there.
And what's interesting, you know what they say, what goes up sometimes must come down.
Well, you tell that to the broader market, because I would love to see nothing more than the broader market come down a little bit. We've had a few hints of it, but definitely hasn't happened. But when you really start peeling back some of this earnings release, you can understand why the company's stock price fell and why their multiple came down a little bit.
I think I have to know why. You know, when you sometimes just leave the top open to the Clorox container, you go in to reach for one, and it's just a dry piece of paper at that point.
I guess that's why. Probably not, but it could be one of the options. Maybe they just left all the container tops open in their warehouse and they just had to write that shipment off.
Or maybe they've mixed a batch of Clorox with Kingsford's charcoal.
Or maybe it's because their sales were down 9% in the last quarter compared to the same quarter last year, while they have had showed year over year growth in the last fiscal year of 9% in sales. Their earnings fell significantly, dropping 24 cents on the EPS. Now, Lanny, were there other issues that helped contribute to that?
I mean, Bert, you really hit it on the head though, brother. Their quarter went from April 1st to the end of June. And if we don't remember, let me remind you, that was one of the worst quarters ever, period. Life and the markets. So Clorox was definitely firing on all cylinders, selling their Clorox wipes, selling their Pine Sol, their Poet, their anything you get your hands on that was cleaning, disinfecting, whatever. That was one of their record breaking quarters ever. So comparing this quarter to that quarter, it was going to be hard to keep that rate of growth up.
Yeah, it's going to be hard to compare WrestleMania matches to a Rock versus Hogan and anything going forward because they got a very high bar to cross right there.
No, I mean, you're 100% right. But I think what you're hinting at was kind of what's going on in the economy right now, everybody. Supply chain right now is being shattered, shunned, delayed, you name it. Right now, it is just hard for production, somebody who makes something produce those things because of gaining what they need to create their output. And then Bert, what is something that we always talk about on our videos? What do we always preach about the growth rate compared to what other rate?
Inflation, and much like so many other companies out there, Clorox is getting costs are increasing because their cost of goods to go into these products are jumping up. And thinking about the sector that they operate in, while Clorox is a great bleach brand, they aren't the only bleach brand, so they can only increase sales and prices so much to help offset those increased costs, which leads to why you still see some sales growth or a decline in sales that is less than the decline in EPS. So it's a really hard market for a company like Clorox where costs increase so much, but you can only increase sales so much to offset those increases.
And I think they've ran into, kind of the competition, the store brands, the very generic brands, and even your business suppliers of your primary products. Sometimes they're all generic. Well, they were coming out with their own products. I remember our business, we were trying to buy Clorox wipes as often as we could find them, but then we were also second-handedly trying to buy just whatever wipes were available.
Yeah. But yeah, and as the market caught up to Clorox, it makes sense that why their products are now, you can see them on the shelves, why you can still get them because people found cheaper alternatives elsewhere.
And then Clorox had to do, as you'll read in their earnings release, they had to do a lot of what they call kind of like product volume mixes, where instead of buying the one package, you got to buy the 3-pack to help them get those products out. Because obviously, if you look at their balance sheet, inventory is a true item on their balance sheet, something that they want to move. And last June, inventory was only, I believe, 454 million. This end of June, it's 752 million. So they're sitting on now inventory.
Yeah, that's interesting. And that's fascinating to see. So, I mean, you can kind of see that reflected in some of the other items too, and some of the other ratios that you have in here. We always love to look when, in addition to inventory for a company like Clorox, we will look at the company's current ratio and their quick ratio. And I think quick ratio and current are going to be very important here because we want to make sure that the company's current assets, which are less than 12 months, can pay their current liabilities, which are due less than 12 months. We like to see that your assets are greater than your short-term liabilities. So we're always looking for one that's over 1x. Interestingly, their current ratio is only 0.9x at the moment. Do you want to tell us what their quick ratio is, Lanny?
Yeah, and before I jump into the quick ratio, so Bert just said 0.9x. In comparison, their current ratio this time last year was 1.4x. So much more liquid, had much more quick, current assets over current obligations. But their quick ratio, which obviously the bar right now is 0.89, it's not, or 0.9, it's not going to get higher than that because the quick ratio takes the current assets, backs out the inventory, and then takes that over current liabilities because it's how quick can you pay off your debt. And once you back out that inventory, the quick ratio sadly is only at 0.5. 5x.
So they're not the most liquid at the moment. So you can see how that excess inventory is hurting some of their balance sheet metrics right there. The interesting piece then too is the one other item that jumps out here is you don't get the best news about their 2022 outlook either. That was adjusted here in the earnings release as well. So unfortunately, you have some bad news on the past earnings and the past performance. Management isn't giving you much relief here on the future earnings as well, or future sales as well, I should say, excuse me, because they're expecting for the next fiscal year a 2 to 6% decline in sales. So it's not going to, they're not forecasting it turning around and going in the right direction. It looks like we have another decreasing year. So it'll be interesting to see how earnings gets adjusted in future outlooks and future updates in future quarters.
The one thing that they're really talking about in their earnings release, the one bright spot is that, management continues to talk about their projected $120 million in cost savings based on their Ignite strategy. And they do capitalize Ignite. So really trying to cut down costs and get more efficient with production. Obviously, that's pretty common for someone who has rising prices. You have to figure out ways to save money as well. So I wonder if in their, production bathrooms and on their desks, if they're going to have Clorox wipes or the Target brand.
Well, let's hope they can ignite that earnings growth because they can't have another year of a 24% decline. That is for darn certain.
That's for darn sure. So Bert, given that we know about what happened, again, to summarize, lower sales this quarter versus last quarter, lower earnings this quarter versus last quarter, tighter balance sheet, as well as poor outlook. Again, projecting a decline in sales. Again, the Delta variant in COVID could be coming. So they might surprise themselves. So they either are setting expectations very low, in hopes, hate to say, in hopes that their, consumption ramps up.
But the trend that you pointed out earlier with the generic brands catching up could also harm them because they relied so much on that strong sales where they were just ready to go and they were sold out. They're saying other companies are going to be much more prepared this time around. They're going to have more competitors. There's going to be other product on the shelf where people aren't flocking to Clorox and stocking up the way they were when the COVID pandemic first started last year. It'll be interesting to see.
Right. So again, that's more than likely, why their stock price dropped. Essentially, at some points during the day on August 3rd, over 10%, but they finished down just about 10%. But Bert, we're the dividend diplomats. We like to run these dividend aristocrats through the dividend diplomat stock screener. Hit them with the trifecta, you betcha.
Price to earnings ratio less than the S&P 500. Payout ratio less than 60%. Perfect payout ratio is 40 to 60%. Third, history of increasing your dividend. We look at the 5-year average dividend growth rate, how long companies increase its dividend. Lastly, the bonus metric, the dividend yield. After we look at the first 3 metrics, let's kick this off. Where did they end? And from a stock price standpoint, Lanny, after this bloodbath of a day?
At $164.06, Bert.
So with a forward earnings of $7.61, that gives you a PE ratio of 21.56. That is obviously much lower than what we usually see Clorox at, which is usually trading in the mid to high 20s. So it's coming down. How does that compare to the market, Lanny?
Well, obviously the market has actually kind of caught up a little bit to the current PE ratio out there. The current PE ratio based on multiple.com is actually at 35 times earnings. Forward earnings based on 2022 end of the year, S&P 500 trading at a little over 22 times. So
right in line with forward earnings for the market. You don't hear that too often with Clorox. Moving into metric 2, their annual dividend is $4.64. Divide that by the $7.61. That gives you a payout ratio of 60.97%. I don't care that it's 0.97% over our threshold. That is a nice check mark here for us. We're going to give it to them. We're
gonna block the punch and we're gonna fight back. We're gonna get Hulkified here because Bert, that third dividend metric, the dividend growth rate, bring it to us, macho man.
The 5-year average dividend growth rate is 7.66%, and they've increased that dividend for 44 consecutive years, Hogan.
44 years, dating back to literally 1977 of consistently raising that dividend. And that's a pretty good rate. And Bert, what did they do this year with their dividend?
Last dividend increase was 4.5%, so just a little bit below their 5-year average dividend growth rate. Not bad. Not bad. That bonus metric now, that dividend yield, you take that $4.64 dividend, shine it up real nice, and divide it by the $164.06, gives you a dividend yield at 2.83%, double the S&P 500. Interesting here for Clorox.
Interesting. I know there's a lot of investors out there that are scooping up shares. Bert, are you scooping up any shares?
I don't know. It's interesting. In my mind, so just to run through the metrics and summarize here as I go through my decision-making process, P ratio is 21.56, payout ratio is 60.97, strong 5-year dividend growth rate of 7.66%, increase that dividend for 44 years, and they have a yield of 2.83%. Okay, so 3 of the 4 are looking great for me right now. I'm still getting a little hung up here on the PE ratio that is in line with the market, that is 21.56. For a Clorox standpoint, that's cheap. This is cheap when you're looking solely at Clorox compared to things, but it's not cheap compared to the market. And there are plenty of other dividend stocks that are trading at a multiple below that. With that being said, I am going to watch them because of their unique position. And with this 10% drop, my ears are perked. I'm watching them to see if the price continues to slide. What are you thinking, Lanny?
Well, for this pandemic-proof stock, 21.5 is still a little expensive for my taste. I wasn't buying at 190 or 180. I'm probably not buying at 164. That doesn't mean you shouldn't, obviously do your own research, make your own decisions. But if management's or if analysts are projecting 7.6 in earnings, not to say I'm going to get greedy and say, oh, I want to only buy it 15 times, but say if I want to buy it like 18 and a half times, that still is a $140 share price on that projected earnings. Obviously, this is a quality company. They've been through this before. 44 years of raising a dividend. They didn't do that just by waking up yesterday. So they know how to manage companies through cycles. I think I'm with you, Bert. I do want to watch Clorox, watch them closely. I mean, obviously the dividend growth, they kind of knew that the slowdown was happening is my assumption there, hence the 4.5% growth rate. So, that combination is probably just a little low for what I would like to see, at around 7+% on the combination factor, without something that's really gonna, put them on a new pedestal, like, oh, well, we created this new product or we acquired this new XYZ to really fuel sales growth. So, I'll watch them. I think I'll get a little bit more interested to see if there's maybe a 5 to 7% other correction here.
Yeah, that being said, this is huge news. A 10% drop in one day where it ends in 9.5% drop is major news for a company like Clorox because you don't see that too often. So please, in the comment section, everyone, let us know what your thoughts about Clorox are. Are you taking a chance to take advantage of this dip, or are you going to be waiting and watching like we are? We would love to hear your feedback and your thoughts about this great Dividend Aristocrat with some fantastic brands.
That's always the question. Are you buying the dip? Give us a thumbs up on the video. Subscribe to our channel if you haven't. Again, that was Bertha Hurt, and this is Lanny from the Dividend Diplomats. Over and out.